And it was. We look back now. So we're in a very strong bear market right now. This would be the strongest bear market that we've had probably since 1930.
Do you think that it's fair to say that the bull market we had, that 5-year sprint, was more of a cyclical bull market in the context of a greater bear market starting in 2000, 2001?
Yes. In fact, that's a good question. My view has been that the secular bear market, meaning a long-term bear market, started in the year 2000. The NASDAQ went down 80% and never got back even close to the old highs during this last bull market. So that was a cyclical bull market, a shorter-term bull market in the confines of a long-term secular bear market. And so actually, I think if we look at cycles, and I believe very much in a 17-year cycle, if we take the year 2000 as the beginning of the secular bear market, then we should see the next bull market starting in 2017. So it's a little bit too early to go bargain hunting right now.
Well, that's certainly, in Wall Street, they say never catch a falling knife. We've got the small bank stocks. We've got a number of the indexes which have plummeted, appear to have recovered. Even if you wanted to look at the giants, Fannie Mae and Freddie Mac, plenty of people have come in and said, surely they're too big to fail. Makes sense to be an equity owner at these low prices. You'll never have the opportunity to buy things this cheaply again. Isn't that the kind of rhetoric you hear prematurely, solidly in the middle of a bear market, not at the end?
Exactly, and we saw the same thing in the last bear market, 2000 to 2002. Halfway through that bear market, there were some well-known personalities who are now on national TV saying in January of 2001, time to load up the truck, this is the bottom, and this is the end of the bear market, and you really got to buy. And at the same time, we said, this is just a little rally, and 4 weeks later, it will top out, and then we're going to go short again. And that's exactly what happened. So in February 2001, we started selling short again, and then, of course, the rest is history as the NASDAQ really started the huge plunge after that. So you want to be very careful not to be too early. And in fact, late last year, when the sovereign wealth funds, these are these big funds from countries like China and Singapore and so on, and Dubai, and when they were going in and infusing capital into the U.S. banks like Citibank, etc., they said they're much too early. They're going to lose billions of dollars on these investments. And now we have it. They have lost billions of dollars on these investments, and now these sovereign wealth funds, they're very shy. They don't want to repeat that mistake. Now U.S. banks are going to them saying, we need more capital. Can you help us? And these sovereign wealth funds are saying, we're not really very eager to do it right now. So the kitty is empty. The banks have run out of capital. And this is the dangerous thing. Therefore, banks are not in a position to make new loans. And when the banking system is in such dire shape that they can no longer make loans, that's the end. Without credit expansion, the economy cannot possibly recover. And this is a theory of liquidity that I proposed in 1977. It was my first conference speech, so a long time ago. And I said the secret key to the investment markets, it's liquidity and credit that you have to look at. When credit expands, the markets must go up. When credit contracts, the investment markets must go down. There's no alternative. So forget all of these financial ratios and all of that stuff. It doesn't matter. You just have to look at credit.
So for stimulus to get that credit going again, do you think we're going to follow a Japanese model and just continue to lower rates to zero?
Yes, that will eventually be the only thing that they can do. Right now, these infusions of capital that the Federal Reserve has done this year so far, $400 billion. That's a pittance when you compare the tens of trillions of dollars of debt that are going up in smoke. That just doesn't do it. They're basically trying to replace a small fraction of the money that has disappeared by way of bankruptcies and foreclosures and defaults. So the problem right now is not that the Federal Reserve is putting too much money into the system, that this will cause huge inflation down the road. That is the wrong worry, and unfortunately everybody's concerned about that. They see the inflation numbers. But, you just have to go back to any strong recession. Like in 1974, that was horrendous. The value line, the stock index was down 82% in that bear market. And they were still fighting inflation right to the bottom of that recession. They were fighting inflation. And, they say they know that inflation takes a year to 18 months to get out of the pipeline. But then when the inflation numbers stare them in the face, they say, we have to do something. But the inflation that we're seeing now emerging actually went into the pipeline a year and a half ago.
Mm-hmm. One of the points that you made a couple of newsletters ago was that by the time you actually get to the end of the recession, that's when you actually start seeing the deflation. There's a delay there.
Exactly, and it's always in the recovery period when the economy strengthens that inflation goes down. This is totally contrary what you hear from all of these economics professors that are on the Federal Reserve Board. That is one of the big problems that we have academics at the Federal Reserve. They have no real-life experience.
And you've stated pretty strongly, you look at Robert Mugabe, who is also an academic, you mentioned in your most recent letter, with multiple degrees from Oxford University, and he's managed some phenomenal financial feats, and will go down in the annals of world political and financial history.
Exactly. Zimbabwe has over 100,000% inflation right now, and he's an academic. I think he has 3 PhD degrees. Economics.
Yeah, Oxford doesn't always turn out the best. It's an interesting school. The bear market that we're in, we've used that term in 2 different contexts. We've said that there was a bear market for a couple of years already in this decade, and we may be heading into a bear market again. Just to clarify for our listeners, we're really saying that there are little bear markets and big bear markets.
Right.
As there's little bull markets and big bull markets. And these little ones take place in a much broader context, whether they are bears or bulls. And so that's really what we see is a deterioration in fundamentals, a further deterioration in fundamentals, entering a new cyclical or small bear market, which is actually in the context of a much larger, what they would call secular bear market.
Right. And this is a secular bear market, which is, the best equivalent that we can find in recent history is Japan. The stock market made its top in 1990. The central bank at that time, the Ministry of Finance, declared that they were going to stop the rising prices in real estate. And that was it. That was the signal that the Japanese boom was over. And at the time, I wrote in the Wellington letter that Japan would see a 10-year period of disinflation or deflation, and it would be a very strong recession that they would not be able to get out of for 10 years. Well, I was much too optimistic. It actually took them about 14 years to get out of it, and only for a very short period, because now Japan is going back into a recession.
Once again, you're listening to the McAlvany Weekly Commentary. I'm Kevin Orrick, along with David McAlvany, and our special guest today, Bert Dohman of the Wellington Letter. Bert, you had been talking to David a couple of days ago and mentioned to him, just a reminder, that in 1981 you had called for 20 years of a deflationary cycle. And now you're calling for, as of 2001, you called for a 30-year inflationary cycle. So what we're talking about, those are those long cycles that we're talking about. Is that correct?
Yes. In 1981, in fact, we had been in gold right up to the top in the late 1970s. And then gold broke a very important trend line. For us, it was $694. And after that, I said, for the next 20 years, the only way you're going to make money in gold is by selling short. And we said the next bull market will have to wait 20 years, the next bull market in gold. And people thought, there were some people that even called and said, is that a typo? Is that a mistake? And I said, no, it's a 20-year down cycle that you have, and then it's a 30-year up cycle. Now, in the 30 years, of course, you can't have something going up for 30 years continuously day after day. So obviously there are going to be bear markets in this secular bull market of gold. And I think we have started one of these little bear markets in the precious metals right now. But long term, I am very bullish on gold because the central banks of the world have no alternative but to just try to inflate over a long period of time their way out of the current predicament. And that means that paper money is going to deteriorate in value continuously. And I'm not talking about just the U.S. dollar, all currencies. I'm talking about all currencies will decline versus gold. But that does not rule out substantial corrections in gold. In a major bull market in